Hi, this is Fico, and today I'll be talking about the fall of SVB, the Silicon Valley Bank. SVB was a bank that operated in the Silicon Valley area in San Francisco, and their main target was the technology industries. So they worked with startups that would capture investments and deposit in the bank to start in a safe way, and also startups that needed to raise capital to run their business. So they would borrow money from SVB. So that's the way they kept money circulating in the system. They would get deposits from one side and lend money to other companies on the other side. Okay, but how does that work in general? Banks today, they don't have to keep all of their depositors' money into a safe. They only have to keep a portion of it available. So it's generally something up to 10%, and the other portion they put back into circulation. So if I deposit $100 into a bank today, they only have to keep up to $10 into a safe. The other 90, they lend to other people so they can make a profit. That's how banks run, that's how they make a profit. But that adds a lot of risk to the depositors. That's why the government steps in. The government has agencies to insure the money. So in case the bank cannot fulfill their promise to pay back my money, the government steps in and pay me back. But that's up just to a certain value. Today, if I'm not mistaken, it's up to $250,000, which is a lot for a normal person like me, but maybe not to a corporation. Corporations need to move a lot more money around, so $250,000 is not that much. Alright people, and how did SVB manage the money? So SVB would work with technology startups. They would get their money from investments, they would deposit to an SVB, and they would lend this money to other startups that needed to raise the capital. But during 2019, during COVID, we had the lockdowns. So a lot of industries were affected and the money moved to the technology industries because we had the ability to work from home, and that was a huge potential to keep the industries running. So the investors started pumping money into technology, and this money came to SVB as their depositors were bringing more and more liquidity. But they didn't have many borrowers, so the money was just sitting around, and that's bad for banks. They need to put the money to work for them so they can generate some profit. So what they did was they started acquiring Treasury Bonds. The way bonds work is that you buy it at a certain price, and based on the interest rate at that moment, you know how much you're going to make as a profit once it's finished. So you have a set date, and once you get to that set date, you receive your money back plus the profit based on the original interest rate. So they acquired a lot of those bonds, and they said, okay, we're just going to keep the reserves, we won't touch on them, and after some time we get it back with a profit. So it seems to work well, right? Well, not really. So as the economy started going to a bad direction, there was less money flowing into the technology areas. So there was less and less depositors putting money into the bank. At the same time, some depositors had to cash back. They had to withdraw their money to keep their operations running. So the reserves the SVB had were shrinking. They needed to keep that liquidity in order to fulfill their promises to pay back those depositors. In order to do that, they had to access the reserves, they had to sell some of their bonds before the end time. So they had to sell at a discount. The problem is the size of the discount. As the economy was struggling, Fed started to raise the interest rate, which made the new bonds much more attractive because at a higher interest rate, they were offering a better profit in the short term. So the older bonds, they were just unattractive for investors. There was just no demand to buy it. That made so that SVB had to sell them at a big discount. When they did that, they realized a loss of $2 billion. Selling those reserves allowed them to regain some liquidity back, but they needed to think about the next step. So as a next step, they thought about raising some capital by selling stocks and getting an investment. And by doing this, they expected to get more liquidity and keep things going well until the bonds went to the final date and they got their investment back. But in the meantime, they also announced to the market and the depositors that they had to realize a loss of $2 billion. And that generated a side effect. The companies started to freak out. If the SVB has to access more reserves at a high interest rate, they're going to sell at a discount. So that means more loss. if they're getting a loss every time they access the reserves, they won't have enough money to pay back all of the depositors. So I need to take my money out as soon as possible. That had a huge impact on SVB. So as people started withdrawing their money, the stock price was going down, and that generated a cascading effect known as bank run. Everyone was taking out their money, the bank had to access more and more of those reserves and sell at a loss, and as a result, it broke SVB. Alright people, and how does that affect the crypto markets? So the best example here is USDC. USDC is a stablecoin, and stablecoins are types of digital assets that have their value pegged to a different asset, generally a fiat currency. So in this case, USDC is pegged to dollar. We have Circle, the entity that manages USDC, and it promises to sell 1 USDC at the price of $1 and to buy back 1 USDC for $1. So this promise is what keeps the peg going on, and they provide confidence by showing the reserves they have and showing that they're capable of fulfilling this promise. In USDC's case, their reserves are diversified. The biggest portion, according to the newest data, around 77%, which is $32 billion, are invested in US Treasury Bonds. In this case, these bonds are set to expire up to 3 months from now. So it's a very short period. They can access the biggest portion of the money in up to 3 months. The other portion of the money, 32%, which translates to $9 billion, are spread across different banks. A third of those funds were stored on SVB. And as the word spread out that SVB might not be able to fulfill their promises and pay back that money, people got scared. They started selling the USDC in secondary markets. So as they did that, they started selling at a discount. And that made so that USDC depegged from the US dollar. During a 3-day period, they went as low as 80 cents and then went slowly back to $1. And that happened because as people were selling their money, some investors started to notice that it was just a portion of their reserves that was compromised by SVB, and they still had a great portion of their reserves in trusted places. So they started seeing that as an opportunity to buy USDC at a discount. So they started to buy USDC until the money slowly went back to peg, and now is again operating around $1. So the main conclusion I wanted to bring here for this video is that crypto markets are not immune to traditional finance. You gotta be careful. A lot of the projects are still connected to centralized institutions and the same risks. So understand the project and make sure you understand what are the risks you're getting exposed to. These were the main topics I had for today. I hope you guys enjoyed. If you have any questions or further topics to suggest, just leave it down in the comments and we'll tackle in the next videos. So see you around.